All right, so good morning, everyone. Thank you so much for being here today. You can all see my slideshow here. Yes?
Good to me.
Yeah? Okay. So I'm really excited to host this because today isn't just us about agents or just about mortgages. It's about how we, as agents, elevate our business by building intentional partnerships and truly understanding the tools available to our clients. So here is myself, Megan, and then Jordan, our mortgage agent here for today with Mortgage Brokers Ottawa. So today is about one of the biggest shifts in our industry, which is over the last few years, is that clients expect more from us. They don't just want someone to unlock doors and negotiate offers, because that's the absolute minimum that we do. They want guidance, strategy, and solutions. And the reality is, we can't be experts in everything. But what we can do is build powerful relationships with who people are and with people that we're surrounded with. Yes. One second. I lost my little thing. Good. Okay. The mouse is going. So, the power, why vendor partnerships matter. For me, partnering with strong vendors, especially in mortgage, legal, inspection, and financial services, is absolutely integral to how I run my business. When we understand their products deeply, we ask better questions, we identify opportunities earlier, we prevent deals from falling apart, and we give clients confidence in uncertain situations. And confidence is everything in this market. So how this helps our clients is think about the types of clients that we're seeing. First-time buyers who are overwhelmed and don't understand what they can afford, self-employed clients who think that they don't qualify, investors and buyers with bruised credit, and adults sitting on equity but unsure of their options. If we don't understand what solutions exist, we can't properly guide those conversations. And sometimes the difference is between a no and a yes. And it isn't just the client, it's the strategy. So, how this strengthens our business and why it's integral to our business. Strong vendor relationships also strengthen our business in ways people don't always talk about. Fewer collapsed deals, faster turnaround times, stronger negotiating positions, cross referrals, co-branded marketing opportunities, and educational events like this. When our partners win, we win. And when we work collaboratively instead of transactionally, the client feels it. So I'll introduce Jordan. So he is Jordan Vigile with Mortgage Brokers Ottawa, and he's somebody I'm really excited that I intentionally partner with. Jordan and I have worked together on multiple files, and what I appreciate most is his solution-oriented mindset. He doesn't look for reasons to decline a client, he looks for ways to structure the deal properly, and that's really important. And in today's market, that mindset is invaluable. Today, Jordan is going to walk us through key mortgage topics that directly impact our day-to-day business. Business for self-lending, alternative or B lending solutions, and reverse mortgages. Though these are conversations we're already having with clients, but today we're going to understand them at a deeper level so we can lead those conversations with more confidence. So Jordan, thank you for being here. I'll let you take it from here and I'll just transition him to be the host. Okay, Jordan,
Awesome. Thanks, Megan.
welcome.
Thanks for having me. I should have control now, eh?
Mhm.
So, yeah, thanks for joining, everyone. As Megan said, Jordan Vigili, with Mortgage Brokers Ottawa. I'm not going to take too much of your time and give a whole introduction, but I'll give you a quick background on kind of where I came from, just so you'd understand. I think it's relevant as well. So I came from the banking world. I started actually as a teller. I went from a teller. I originally wanted to get into finance, become an investment advisor. So I got my CSC. I went from there, and then I was a personal banker. um, which does a lot of things. So they do things like, accounts, credit cards, business, personal accounts, all this stuff. And one of the things that you need to do, one of the roles is mortgages. So I started to do mortgages, and I really liked the big ticket items. I loved how rewarding it was, how it can help my clients. I like the commission aspect of it, and how you can jump right in, right? Like all of us, there's no ceiling with it. And from there, I became a mortgage specialist with the bank. I was with the Bank of Montreal. So that was great. A lot of experience there. And then I went from there to the broker side, which gave me more options for my clients, which I'm going to speak about. So the relevance there is that I have that background, and it could help for things for a lot of different reasons. One of them being, let's say a client, for instance, if they need to put a down payment, right, or gifted funds. Let's say gifted funds where they're getting funds from a family member, parent, or a brother or sister or something like that, right? They could be depositing that money into the account. So I know things about the statements, about the deposits, how long it's going to take. If there's going to be, sorry, Megan, I think the slides they're changing, which is fine. I'm just chatting, but I don't know if I have control. Sorry, that's why I think. Sorry, I can't hear you either. You're on mute.
You you can hear me now? Can you not?
Yeah,
They're changing? Sorry, I'll go back then. I didn't know that.
yeah, that's okay. It's
Here,
all
I'll
right.
change it now.
They got a little sneak peek then.
There. Okay, they're back. They're
You know
back.
what? I think it's my fault. I think because I have to share, right? My apologies. I got
Oh,
to share my screen.
yeah.
Um, which is fine. Replace current share, and then I'll go to
Oh, here, wait. I know. There, go. You're good now, I think. Now I stop sharing, and you can start sharing.
there we go.
Good?
Does that
Yeah.
work?
Yeah. There. Sorry, I didn't know it was you.
It's okay.
Technical difficulties.
Yeah, yeah, it's all good. It's all good. We're getting
There you
there.
go.
Okay. Anyway, so yeah, where was I? Thanks.
You're explaining yourself.
So pretty much, yeah, just being able to have that kind of experience in the background of how things work, right, is going to help clients, and clients are really happy with that. I mean, there's some agents that came from the banking world, but I think having that experience, even from being a teller and knowing the back end, is helpful, and clients do normally appreciate that. Because clients, a lot of them, even if they're not going with a bank for their mortgage, they are at a bank, they need to pull out a check, or they need to do something for the deposit, or for whatever the case may be. So that helps. Yeah, so then fast forward to now, and being, having all these options like B lending, which we're going to chat about. I'm not going to specifically go over business for self. It's going to be intertwined a little bit into B lending, because a lot of the time, especially business owners, they have to use an alternative kind of lending just because of the way they pay themselves. And nowadays, as we know, not only have, home prices have increased, but incomes aren't necessarily going up, or clients, maybe they can still survive with the normal, 80 to $100,000 that they're paying themselves in salary as a business owner, which is fine, especially if you have, two owners, and maybe they can get by on that, and they have multiple properties, and it's working for them. But the way the banks and a lot of the lenders look at it on the A side, right? It's a ratio based system. They look at the numbers, very straightforward. Yes, credit bureau matters. Yes, loan to value matters. But really, it's, can you afford this mortgage based on our criteria? And a lot of the times with traditional lending, it's the answer nowadays is no. Even if the client has great credit, even if they have income and they're able, they say, Jordan, like, listen, we can afford this. We're paying for it. So we've been paying our mortgage. We know how to do it, but the banks don't look at it. So this will give you alternative lending, gives clients just an extra kind of weapon in their arsenal to use if they do want to refinance or purchase a new home, or whatever the case may be, even renew. A lot of times it'll allow clients to do that. So we'll move on here. So as I mentioned, it's going to be used for clients that are trying to qualify outside traditional loans. So it'll serve clients that don't necessarily qualify with traditional banks, or even non-bank lenders on the A side, due to things like I said, like servicing ratios, could be credit score. Maybe they have, and I'm getting a little bit ahead of myself here. You'll see, but maybe they have things they need to pay out or tax arrears. So we can do things like that on the B side. It's very flexible and it's case by case. Whereas on the A side, it's really there's a little box and you either fit inside it or you don't. So as I said, flexible income to debt ratios. This is like most things on the B side is going to be very file dependent. So it depends on many things, loan to value, credit history, credit score, income, how we're looking at that income, right? Salary versus maybe, dividends or, sole proprietor where they're getting paid net income, um, how they're paying themselves, maybe how good their business is doing, right? If they have financials and how that looks. Lower credit score acceptance. So with the banks now, it used to be 600. Some banks it is, or some lenders, but normally now it's 650 opens the door. So you got to be at least at around credit score, the beacon score of 650 or above for the banks to even start looking. And even then, there's no real line. Like even if you're at 660, the banks really do their own thing and they might not be so open to it. So with B lenders, I mean, some of them, 500 they're accepting. So it really gives that flexibility where clients they may not think they're able to buy because they went to their home bank and they told them no, but they can rather than having to wait who knows how long. This gives them the opportunity to get into the market ahead of time. Previous bankruptcy consideration. So obviously that's a big one. Big no for banks, big red flag. They don't like it, whereas a lot of B lenders, they'll allow it. They'll give that flexibility. Once again, depending what it looks like, how many, how long ago. But it is allowed a lot of the time with many of the B lenders. So the different programs, flexible income requirements. As I said, the income is you can take income from a lot of different aspects of your business. So first off, I'll start with the down payment because I have it here, 10% down payment. Normally on the B side, you're going to be looking at 20% down or more. But there are programs, and I put this in here because people think B lending right away, or some of the programs involved in B lending, you're automatically, you can't put under 10% down, or sorry, under 20% down, or you can't be a first-time home buyer. And you can. I'll give you an example. First-time home buyer that has their own business, right? So self-employed, has their own business, they didn't know any better. They're trying to save on their taxes, so they're paying themselves. Maybe their business makes 100,000 or more, and they're paying themselves. They're taking a smaller salary. I've seen some clients are paying themselves 10, 20,000. I mean, you're not really getting approved for anything there, but their business says well they have high cash flow, right? I had one client that owns that did nails out of her home, so a lot of cash heavy. So there's actually a program called Stated Income, which I'm going to talk about. And we offer this too if you're putting under 20% down. So you have a first-time home buyer come in, they're self-employed, right? They have a minimum down. Normally it's 10% you have to put down if you're using this program. And it's a stated income program. It's a little bit more flexible and less document heavy. If you're putting over 20% down, because as we know, under 20%, the insurers, it has to get by them. So they have to approve it. But there's a way where we can use income over and above, let's say, their notice of assessment or what they show on their tax return. We do need more documents up front for this program because it's got to get by the insurers, right? But a lot of the insurers will accept it if the lender is going to support it. So we can look at things like bank statements, right? We can look at how they're paying themselves, and we can take like an income expense type of look at it where, like I said, they may not be claiming very much, but we can usually gross it up a little bit and use more. So long story short, clients with that 10% down payment, whereas probably no chance of qualifying at the bank. The bank's going to look at traditional lending across the board for the most part. We can do it on the broker side. So it just opens up more doors and gets them into home. They're being able to buy a home a little bit earlier. Um, so debt coverage capability. As I mentioned, this program is really good for clients that need to pay out certain types of debts. This could be, it's mostly going to be if people want to consolidate. So refinancing, it might not be more on the real estate side, but it might. You might need to refinance to buy a place, or maybe, you're going to refinance first, sell it, and then purchase. But either way, when you're with a bank or a large bank, and like I said, I was there, they usually don't, they're not too open to paying out things like tax arrears. So personal income tax, property taxes, you know, and even then, if you have taxes owing for years back, right, it's a red flag. They're going to ask questions like, why? Why do you have, what's the reason? Can you not afford your bills? Why do you have those taxes? Where on the B side, this is known. They understand that there's reasons why you're coming over the B side, and they will more or less pay out anything. So they'll take a look at consolidating tax arrears, personal income tax, or property taxes, over limit debt. So if your credit cards are over, a lot of the time the banks are going to want you to bring that debt within the limit. They're going to want you to, make sure your taxes, property taxes are paid up to date. They don't want to see any income tax owing. So they want all that covered ahead of time before you go ahead. And even then, if that even comes up, that's a red flag to them and they might just back out of the file. So on the B side, like I said, a lot more flexibility and it can be used to do things like pay out, all sorts of debt. Extended amortization terms. So another really big one on the B side, up to 40 years, which is unheard of with A lenders, right? There's only certain lenders that offer this, and I have access to them. Clients nowadays, rates a obviously a big conversation starter, but at the end of the day, a lot of the clients I'm speaking to, they're looking for cash flow. So the rate is important, but a lot of them have rentals, the interest, they can write off a lot of the interest. It's really how much cash flow do I have every month? And obviously amortizing it, over a longer period is going to give you more cash flow, especially with, and you'll see on my next point here, when the rates are higher. There's B lending, right, is more risk. So there's going to be a fee that's involved with it. And the rate's normally going to be higher. How much higher? It depends. It's not always a lot. Sometimes, you're still in the fours in some cases, or you can go up to 5, 6, 7% plus, depending on all things. Is it in first position, second position? What does your credit bureau look like? What does the loan to value look like? So all these things are taken into account. Whereas on the A side, loan to value, yes, but credit bureau, as long as you're within a certain range, the rates normally don't change too much, especially with banks. It's either you kind of qualify or you don't, and you need to have all of these other things in line. Whereas on the B side, it does make a difference, right? So with the rate being higher, obviously comes a higher payment. There's a fee, you got to roll that in. So amortizing it over a longer period, obviously, you know, gives the clients a little bit of a break. It lowers their payment a little bit, sometimes lower than, if they had a lower rate. So they can do that, helps them cash flow until, they pay their mortgage down. Then they can re-amortize, or they can just, apply lump sum payments. So there's a lot of options to bring that amortization down a little bit more. So as I mentioned, there are usually higher interest rates. It's really dependent. It's hard to say. I think a lot of people, when they think of B lending right off the bat, they're like, oh, it's 10, 11%. It's not. I mean, some cases, very rare, right? If usually very short-term solutions. Normally they're pretty doable, especially when you're looking back like year and a half, 2 years ago, where rates were around high fives, like low sixes. People were paying that A lending. Now, for instance, I did one for a client. I think they were like mid fives on the B side. And let me tell you, they were super happy because it was either that or they don't pay their bills. They had contractors they had to pay the whole 9 yards. So it was very tough, but they were extremely happy to pay, the 1% fee that they had to pay and then get a little bit higher of a rate if it means getting their mortgage. So let's go to the second slide here. Oops. I'm just gonna move it here. Sorry, the little box is in my way here. Just give me a moment. Okay. Perfect. So strategy, because there is a strategy. We don't want to keep clients. So this program is meant to help clients, right? Many reasons. Refinancing, consolidating debt, but in your case, it's going to be, for referring, to you, real estate agents is going to be to get into their home earlier. So we don't want to, we want to get them into the home a little bit earlier where normally they wouldn't be able to. And I'll go over some reasons why they wouldn't, but maybe they'd have to wait a year or two, especially if they're talking with the bank, because the bank's not going to say, hey, go over to that broker over there, go, give away our business. They're not going to do that. And a lot of times, not that they mean to, but they don't know. Like I didn't know. They don't train us for that when you're in the bank. When you come to the broker side, you know about all the different options you have. But long story short, the reason for B lending is really just to it's to create an alternative solution for people, right? But it's short term. So it's typically 1 to 3 years, flexible turnaround time, 1 to 3 years. We want to get them in, and then we want to look at moving them to an A lender at a lower rate as soon as possible. And I'll usually know ahead of time, right, how long. I'll talk with the client depending on their situation, what the future looks like. I coach them the whole way through. I talk with them the whole way through. I'm not transactional based. It's not like in and out the door. So we help them at the beginning to know kind of to plan for how long they're going to be in B lending and then actually getting them over. So short term, we're not locking them in a higher rate or 40-year amortization for a long, long time. It's just to help get them started, and then we'll graduate them over to an A lender. Some of the B lenders, a lot of them have graduation programs, so they have an A side, which is really nice. So you're with the same lender, they know your situation, they see you've been making your payments, you've been doing really well, and then when your maturity comes up, or even before then, if you're ready, they can move you over. Or I can move the client over to another A lender. But the whole point is really to try to get them over to the A side and help them save more money. So as I mentioned, it's for clients that are trying to rebuild credit. So if their credit isn't that good, right? Once your credit's not good, like what do you do to rebuild it? You need to get credit. So you start on the B side, right? And then hopefully your credit improves to move you over to an A lender or a bank. Um, this is a big one. I mean, you're going to see this more. A lot of clients I find on the B side, yes, there's clients with, maybe the credit bureau isn't that good, or who knows? Could be for a lot of reasons. Maybe they have arrears, but a lot of clients actually they're good right across the board. Credit bureau is good. Um, Taxes are paid, everything's paid, making payments, you name it, right across the board. But they're not in line with the ratios. So what do? They have to look at alternative options. I'll give you an example. There could be a client. I have a lot of business owners that, the business is doing great, 255, $500,000 a year, whatever it may be. Point is, they're doing great, but they don't want to claim all that income, right? They're not going to take a $500,000 salary. They're expensing it, right? They're on paper. Maybe they're only paying themselves, $80,000, $100,000, trying to buy a home at $1 million. You have car payments. You have maybe another house or rentals. I don't going to tell you that it's going to be very difficult to qualify in the traditional sense, but maybe their cash flow is strong. So what they're actually bringing in into their business account looks really well. So this is where we can use alternative types of income to help qualify them. It's a difference of not getting approved and then actually getting your dream home or getting, a home that you'd like. So I'll give you another example. Let's say, client, you're talking with the client, and this is the whole reason of this is not for you to be experts on it, it's just to know that you have options. So if you're speaking with a client and maybe you're chatting with them, you're driving them around, to look at different homes, hopefully they've been qualified and maybe they think they have. Maybe you're looking at places that are, $500,000 is their max. But as you're speaking with them, you uncover that they really want, they want to be in a single family home. They want to be in a detached home. They love that they were looking at a house they love, 750 to 800,000, but they can't qualify because they have a business and they don't pay themselves a lot. And the bank told them it's 2 year average for business income, which it is on the traditional side. So they just can't. They're going to have to wait a couple years and, you know, light bulb right away. No, I spoke with Jordan. You can chat with them and say, I have a broker. You should speak to my broker. And possibly, try to find a different solution. You don't have to make them any promises, but maybe there's more options for you. So we can use, and I think it's on the next slide, but we can use something called, like I mentioned before, stated income, which, as the name suggests, you just essentially state your income. There's a little bit more to it. You do need some invoices to show that you're, making money. You need it. We take a 12-month, most recent 12-month bank statement, right? All lenders do it differently. Some will just look at what's coming into the bank, they'll less the expenses from it, or maybe we take a 50% of your gross income. But long story short, you're able to use a lot more of your income versus, paying yourself a small salary or a smaller salary, but your business is doing really well. Your business is doing great. You have lots of cash flow in your business. You can't access that for your mortgage a lot of the time with traditional lending, but on the B side, you can. So a lot of the time, especially if clients are making, really good money in their business, it's better to save on taxes, right, on the income tax side and pay a little bit for your mortgage because at the end of the day, you're going to have to pay one way or another. You're going to pay, to the government or you're going to pay a little bit more on your mortgage. You can't have it both ways. But a lot of the time it's more beneficial to maybe pay less taxes but then pay maybe a small fee on your mortgage just to get you into the market, and maybe a slightly higher rate for a few years. And we can do that. We can look at someone maybe that's qualifying, 80, $200,000. Maybe they're making 250, 300. We may be able to qualify them on 200,000, 220. It's case by case. But I don't have to tell you that going from 100,000, to 250, you're qualifying for a lot more. That's a difference. So whereas that client, maybe they were looking at $500,000 homes, now you've opened them up right up to $1 million. Not only are, benefiting the client, obviously, because they're getting into the home that they love, but it's obviously benefiting you because it's a higher ticket price. So really, really good. It's a really good program, very flexible, and it can help a lot of clients that fall into these guidelines, especially self-employed, commission, if it's cash intense, right? But they don't have a lot of taxable income. As I mentioned before, too, loan to value. So the lower the loan to value, normally the more flexible it is. It's not just loan to value, there's credit bureau, there's a lot of things that we look at, right? So it's really case by case, depending on the client's overall situation. They may not be too far out of kind of the A lending realm. They may not be, like I said, at 6 or 7%. It might be a slightly higher rate, a small fee, just because of their income, because everything else is great. They have lots of equity in their home. So that's where it's a lot easier to find solutions for them. So, okay, reverse mortgages. This is a great program, which I'm excited to talk about. It's something that hasn't gotten um, a lot of attention, really, but more, I think, in recent years. And it's really important to me and really exciting because it really does provide a different solution for a lot of clients that wasn't really there. And I think Megan and I were just chatting, and we had a rep that came to Ottawa and was chatting with us, and I think the number was there's more people over 55 than there are teenagers. So this is becoming more available to so many people. And it's opening up, right, doors for these clients themselves, but also for the younger generation. And I'll go over some of the benefits because at the end of the day, the benefits are for these clients. They want to see how it's helping them, even if they're doing it for someone else, like a kid or a grandkid. So it's designed for homeowners 55 plus, right? It's age dependent. It provides tax-free access to home equity. So obviously a debt is not taxable. So you're instead of having to, and I'll explain more about the product, but instead of having to sell your home, right, and tax implications are pulling out of investments, RSPs, it's you're accessing debt in your property, which is tax free. You're accessing equity in the property, and which is debt, and it's tax free. There's no monthly mortgage payments required, which is huge. I know when I tell people this right away, it's like, wow, really? Yeah, I mean, that's the name suggests it's a reverse mortgage. So there is interest that accrues. You do owe on the mortgage. It's not that it's free, right? You're not paying it up front, repayment occurs when the property is sold or it's vacated. So there's interest that's accruing, right? Interest is normally maybe a little bit higher, but you're not seeing those payments right up front, which is huge, especially for income supplementation or for a lot of different reasons. People don't have to have those monthly payments weighing them down, especially if the whole point of accessing the equity is to help with cash flow, is to help pay off the debt, but then you're adding, another monthly payment. That's kind of backwards. So this allows them to access the equity without, having that monthly debt burden right off the bat. Now it's important to mention, you can make payments if you want, but you're not obligated to. So some of the benefits could be, limited cash flow, ability to remain in your home, on the different qualifying criteria across the program. So it's going to help people supplement retirement income. If older people, whether it's 55 plus, maybe some in their 70s, right, have retirement income. You know, Costs are always changing. Inflation's high. I don't gotta go and harp on the cost of living nowadays, but the a lot of the times, especially as you get older, right, cash flow becomes limited. So it's going to help to access some of that equity to help with cash flow, whereas maybe your retirement income isn't doing the job. It's going to help with cover living costs, maybe healthcare, renovations, and options to consolidate some higher interest debt. Like I said, with no monthly payment, gives them the ability to remain in the home. So whereas, clients may have to sell their home and move, to maybe a smaller, to downsize or to go into like a retirement home, they don't have to. They can access that equity that they've paid into and help them remain inside their home, which a lot of people want to do as they age. Qualifying criteria. This is an interesting one. So normally there's no TDSR, so there's no debt servicing ratio for the most part, and there's little to no income qualification. If the credit bureau is under 600, or there's other flags that pop up, if you have tax arrears going back for years, you still need to take care of the property. You still have to pay your property taxes and maintain the home. So the underwriter, when they're looking at the file, is going to want to see that you can do that. So if there's flags, they may want to see some income. They may want to look at the ratios, but normally there isn't. It really comes down to the equity in your home and your age, and obviously the property type as well. So as I mentioned before, interest is going to accumulate. It's not free, which can reduce obviously the remaining equity later on. But as the home price, value increases, you can then actually sometimes refinance and pull out more equity. But normally the interest, it does accrue, and then it does need to be paid out at a later date. Once again, as I mentioned, homeowners, they have to maintain property taxes, insurance, property upkeep. That stuff all remains the same. They're just not paying their monthly mortgage cost every month. So as I mentioned on the last slide as well, it's best fit for retirees, limited cash flow, help them. Investments, a lot of people don't want to access their investments for obvious reasons. I mean, well, first off, it could be maybe it's down their investments, and there's always swings. It's going to come up. They don't want to cash out at a loss, or there's tax implications, so they don't want to do that. So they can access the equity from their home tax free without having to be hit with the tax burden. And as well, again, those seeking to remain in their home long term. Okay, so this is really the build up. This is what I was building up to the whole time for this, is how it relates to you, because all this stuff is great, obviously, for the client, but that's really the thing. It needs to be good for them, because as we say, the first one, which is kind of the most important, I think, and we're going to see a lot more, is that it enables the parents to gift down payments to children now rather than waiting for estate distribution. So waiting down the line, how many clients do we talk to, older couples, even our parents or whoever? Oh, the house is for my kids, this is all for my kids. That's great, but that's at a later date, and we don't know what's going to happen. And by that time, house prices, that could be in 10, 15, 20 years. You're trying to get into the market now, so house prices have gone up, there's tax implication, things are going to change. So this allows people to access the equity and help their kids or grandkids, help the younger generation now instead of waiting. It's like an early inheritance. So instead of waiting to pass on, the equity down the road. Like I said, when there's so many variables, you can do that now and still keep your home. And there's benefits. So, the clients are as much as they want to help their kids or grandkids or brother or sister, however it is, they want to know, okay, well, that's great, but how is this going to affect me? Well, it can have a lot of actually benefits as well for you, like not making those payments. A lot of these people just paid off their home. Now what they want to refinance and add another two, three, four, $5,000 monthly mortgage payment? No, they don't. So they can do this without having that. They can do this, and at the same time, maybe they need some more income. You can take a lump sum. You have to take at least 20,000, but you don't need to take it all at once, right? Like refinancing, for instance, or selling your home. You get a lump sum. You can take monthly income. So you can take 20, minimum's 20,000, or let's say they want to gift their child 100,000. And then they can also, if they're approved up to two or 300, whatever the number is, they can take a monthly supplement. They can take 5,000 a month or two or 3,000 a month, whatever they want to take. And another important part to this is that you're only charged for interest on the amount that is advanced at the time of advance. So even if you're approved up to 500,000, you're not charged interest on that until you start taking that money. So if you're getting 5,000 a month, you're only charged for the 5,000 each month as you access that equity. So it's really great because, like I said, it helps the younger generation get into the market earlier, right? But then there's also benefits for the people that are actually, accessing their reverse mortgage. They don't have to have those monthly payments. Maybe they can consolidate some of their debt. Maybe they could supplement their income. So it really helps. You can also do it at once. So I think, once again, getting ahead of myself, but essentially, on the right side here, it supports multi-generational housing strategies. Maybe they have three kids, you know, they can, let's say the house is worth $1 million. It's all paid off, right? They can access 300,000. You get 100,000, you get 100,000, you get 100,000. All the kids are taken care of, all done. There's no monthly payments. Everyone's happy. And now the children are able to get into a home faster. Parents didn't have to liquidate their investments. They didn't have to go into their savings account. They didn't have to sell their home. They didn't have to refinance. They don't have monthly payments, all this stuff. So it's very helpful for those reasons. And they're still keeping their home, and their home is still increasing in value. So at that later date, 10, 15, 20 years down the road, chances are that money, that loan they've taken out, the home might have raised in value that much, whereas they maybe would have had to sell their home or otherwise. A lot of clients too, you'll notice, parents only have so much money to give. So maybe they only have 20,000 to give them. Well, this unlocks a little bit more. And as I said, there's a lot of people over 55. So this program is becoming available. And as house prices go up, as the cost of living goes up, I know as well as you do, a lot of first-time home buyers, like a very large percentage, they need help. They need some kind of gift to get them going. And the gift keeps going up because the house prices are going up. The ratios are tightening. So they need a larger down payment. So just quickly, that was really the gist of it, but I'll run through the rest. As I said, it allows them to purchase sooner, avoids tax implications. So they don't need to sell their property later at a different date to start, distributing equity. They can do that ahead of time, right? And then avoid taxes when the time does come to sell, because it's a debt, right? Debt is not taxable. Yeah, so creates purchasing opportunities for clients who may otherwise be priced out. Like I said, they can increase the down payment a little bit more and get into a home they want, rather than buying something smaller or buying nothing. But let's say buying something smaller and then having to wait and sell and then upgrade. They can do that right off the bat. Creates the opportunity for homeowners to remain in their home longer, delaying or avoiding forced sales due to cash flow issues. So let's say you do have a client who wants to sell, right? It gives you time to, you want to sell it probably sooner the better, but it gives you time to price it right, to do what's necessary, rather than having to get rid of it. Maybe something came up. That's why they have to sell. It's immediate. Gives them a break. They can pull out the equity. They can breathe while you do your job and sell their home at the right price. It can also help for if you're selling their home and let's say you need to do things like repairs or updates or staging, right? You can, instead of, maybe they don't have any money to do that. So you can then the clients can access that equity to help with repairs, updates, or staging, or whatever it needs to do to get sold. Maybe they need 20,000. So they pull out 20,000 and they do some repairs. Maybe that gets them an extra 40,000, right? When they go to sell. So they're ahead of the game. They were able to do that. They have no monthly costs while they're doing that, right? They're not paying monthly for them for the reverse mortgage if they don't want to. Client gets a higher sale, you get a higher sale, everyone's happy. Supports multi-generational housing strategy. Like I said, strategies, they can do it at once. If they have two, three, four kids that are buying, they can access that equity all at once, rather than having to refinance it multiple times or having a massive, monthly payment where now, they want to travel, they want to do things, and it's going to erode essentially their way of living. And lastly, obviously, as you've probably taken away from some of this, it's going to provide you as realtors with a valuable tool to help clients who are house rich but cash flow poor. Unlock options they didn't realize they had. So once again, going back to that sale or repairs or updates, whatever it may be, they don't have a lot of cash for that, but they do. They have equity. They have equity in their house. So it's a way to pull out that equity in many different ways, maybe where traditionally they wouldn't have been, approved, or they don't want that monthly payment, or so on. So really good product. We're going to see it, I think, more. And I think it's a really good tool for you, for your clients. Now, just quickly, again, you don't need to be an expert on this. I urge you to reach out to me, use me. I'm not transactional. You don't have to worry. I'm here to help. I'm here to coach if you want to know more about these products, right? But ultimately, it's just to uncover, these when you're having the conversation with clients to say, hey, wait, that doesn't sound weird. They went to their bank, but no, there's more we can do. And that's when, you get them in contact with me and I can provide them with their options and maybe, provide them with a lot of options for, either a higher purchase price or maybe multiple kids. You can get into the housing market. So it's just to provide you with some tools to know if there are options and to know that you have someone that has your back like me, that can help to apply these options, to then help you, and, goes around in a circle. So we're all helping each other. That's it.
Jordan, so I'll move on to we'll leave the questions to the end. If you can just
Yeah,
share it for me and then I'll just like wrap it up and then we'll do the questions at the end just because the timing.
perfect.
Okay, so just make me host
Get it back
again.
to you, right? Just take me 1 second here. Okay.
Yeah, got it. Thank you.
Stop sharing.
Okay. You can see it again. Yeah, you can see my screen. Yeah, can you see my screen? Yeah. Okay. Yeah. So I just wanted to say thank you, Jordan, for that. We truly appreciate your time, your expertise, and your willingness to support not only our clients, but our team as well. It makes a huge difference when we have partners who are accessible, collaborative, and solution focused. So I want to transition a little bit to zoom out for a minute. And what we did here today is more than just a presentation. This is an example of how we can position ourselves differently in this business. So what I want to talk a little bit is how you can do this and other events and promote buyer presentations. So our team is actually hosting with Jordan and one of his lenders our first ever buyer presentation geared towards alternative lending solutions, just like we talked about today, the B lending and the reverse mortgage as two examples. So we're doing that March 24th at 5 p.m. at our office and studio, at our studio. This event is designed for educating buyers, generating leads, strengthening vendor relationships, and creating meaningful touch points with past, current, and new clients. So, why innovative events matter? When you host events like this, something shifts. You're no longer chasing business, you're attracting it. And that is exactly how we as agents should reframe our mindset to be being intentional with our marketing, client relationships, and new leads that are coming in. Coming up with new, innovative ideas to be different from everyone else and stand out in a saturated market. You can then position yourself as a resource, a leader, an educator, and a connector. and that builds long-term brand equity. So the real power of events. One event can create new buyer leads, re-engagement with past clients, social media content, stronger vendor relationships, referral opportunities, community visibility, and most importantly, it keeps you top of mind. We encourage agents to there's because there's so many opportunities to host events like this. You can have first-time buyer nights, investor workshops, self-employed financing sessions, downsizing seminars, market update panels, senior equity conversations, and there's so many more opportunities for this as well. I mean, the world is literally your oyster. You can think of whatever you want and hold events like this. The more you do and the more creative you can get with it, the more fun it'll be for your clients to come in to you for you to have those conversations and fun for your vendors as well to keep those conversations and that relationship building. So these types of initiatives can truly open doors to new leads, keep your current and past leads, and create new business opportunities. So I do want to extend this invitation. Anybody is really welcome to come to our seminar. If you want to just learn, get in touch with Jordan, meet with us, look for more opportunities, see how we can collaborate and work together. Our office and studio is available for you to host your own events. If you'd like to book the space, you can message me directly and I'll give you an exclusive coupon to use. But at the end of the day, we want to see everybody here win, and collaboration really makes that happen faster. So, in any way that Jordan and I can really help you do that and create more business and learn and know more, we're happy to do so. So at the end of the day, we're not just here in the business of selling homes, we're in the business of building relationships and the business of people. So when we understand financing deeply, partner strategically, no, I just have a slide, partner strategically, host innovative events, and create education-based value, we build sustainable, referral-driven businesses. And that's how you create longevity in this industry. So just to close, we just want to thank you all again for being here today. Please let us know right now if you have any questions about mortgages, events, or collaboration ideas. We'd love to connect and talk about it. Anybody? Meraldo, what did you think? Do you have any questions?
No, no,
No.
thanks both of you guys.
You're welcome.
That was very
We can host
helpful.
an event.
Thanks. Yeah, I mean, I have to. So I mean, I screenshot like all the information I see here.
Hmm.
So uh, we'll see if I can
Yeah.
come. I'll definitely come.
I mean, it doesn't
Okay.
have to just be you, right? Like, so for the event that we're doing, like our team is hosting it and then introducing a mortgage broker and a lender. But you can do that with like a home inspector. You can do that with a lawyer. You can do that with designer. You can do that with really anybody that you think of that you'd like to have a professional speaking, doing like the bulk
Yeah.
of the conversation, and you're just
Hmm.
connecting your leads to this other professional and showing that you have a strategic partnership with that person or those people so they know, oh yes, like I can trust Meraldo. He knows he
Yeah.
has those alliances that I need for whatever it is that you're trying to connect them to. So like let's say for example, you're reaching out to investors. Well, what do investors need? I mean, they definitely need somebody that can handle, like Jordan talked about, different alternative solutions. They
Yeah.
probably need some contractors if they're getting into multiple units and wanting to renovate some of those units. A property manager would be another professional that you could bring to that type of event. And it doesn't have to be just one, like you could have multiple professionals speaking at that
Yeah.
event.
As I think about it, I do have a question for Jordan.
Yeah, of course.
I operate like Gatineau. Is it like because it's you guys are working like Jordan Gatineau? Is it a place that you provide your service?
Yeah, good question. We do. So I have to co-broker it. We have a brokerage in Quebec that we work with. I'm doing everything. I'm doing the file. I'm talking with the client. Really, they're just sending the documents and they're going to sign it. They're good too. They will help the client. Like they're not just in the background if they need to, if they have questions. So honestly, if anything, they have more support. But yes, long story short, I
So you
can
can
help
you
in
can
that.
you can help like okay, all right, okay, all right. So I have all the information right here. So if anything happens, so I'll let you know, guys. And then
Okay.
because I operate, like I said, Gatineau, so I want to know if you guys, Jordan specifically, if you can help. So I'll
Mhm.
definitely use your 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 help. You
Perfect.
know.
Yeah, thank you.
All right. Thanks.
Thank you so much. Thank
Thanks,
you.
Meraldo. Appreciate it.